Hey everybody, I think Elise's audio is not working today, so I'm gonna just quickly run through the news events and stuff, if that's okay with everyone. Awesome. Like a minute, it looks like people are coming in, so we'll wait a second. Yeah, we'll just go through the news first and then head into events. Mohsen will do the portfolio update, and then we'll do our pitches today. Awesome. So I'll start off with Chipotle. So actually Mirage shared this with me, but Chipotle just launched a tracker to let guests, sorry, that says guests, assess the impact of their orders. So essentially you'll be able to like choose your food and then see like the carbon impact and like how many gallons of water is saved and like the soil health and then like the land supported and antibiotics avoided like when you order. So this is kind of, you know, a new thing in food. I'm sure we'll start to see more and more of it like on menus, like with, you know, you see your calories and then maybe you'll see that your carbon footprint with it, which is, I don't know, it's a super cool innovation. So keep on the lookout for that. And then we'll head. And then the Wall Street Journal put out the ESG Investors Challenge. So this basically said that a lot of investors don't have or aren't sure if they have the information they need to make good ESG focused decisions or socially responsible decisions. So MSCI or Morgan Stanley's Institute for Sustainable Investing also stated that they lack the adequate tools to make ESG investment decisions. And then going from there, they also cited that there's a lack of quality in the data. So this is just kind of highlighting the like necessity and kind of the ESG industry to focus more on getting better data and using better data, and then also increasing the education of investors in this area. Another thing we want to highlight today is the spooky sustainable trivia. So if you saw the first email, we said tonight was the date, but because of another sustainable trivia tonight, we figured we'd do it tomorrow night. So we have straws to give away as well. So everyone that wins will have, I think, 3 to 5 categories tonight or tomorrow night on trivia. And each winner will receive a sustainable straw. So it's a metal straw that says Bentley Sustainable Investment Group, which is pretty exciting. Feel free to join us at 9 tomorrow night. That'll be exciting. I also want to mention that on November 10th at 7 p.m. we will be hosting an impact panel. This panel will host for sure speakers from Evercore, speakers from Loomis Sales, and various other places that we're going to bring together to talk about impact. And then the CEO of the Massachusetts Nonprofit Network will be joining us as well to discuss impact in careers, impact in investing, and then just kind of impact in general to talk about that. And then also talk about kind of the integration of this with diversity, equity, and inclusion. So we may kind of focus on that a little bit later in the discussion, but that should be pretty great. And then I'll hand it over to Mohsen for the portfolio update.
Next slide. Yeah. So last week our portfolio trailed previous slide, please. Trailed the benchmark by about around 0.04%. But overall, the past 2 months, we've been outperforming the benchmark right now by around 0.1%. And next slide. Individual holdings have increased to 6. So NVIDIA passed last week, so it's being included today. And Salesforce, we used to own it last semester, but we were stopped out. Price has went down the past month or so, and so we saw a good entry point, and so we're adding Salesforce. So individual holdings are now 6 companies, which is pretty good from 2 at the beginning of the semester. Yeah, and then I think we're passing it off to consumers sector to pitch Yeti. So yeah.
Hold on, sorry. Is it like sharing full screen?
Yeah, we can see
Yep.
it.
Okay, cool. So me and Ben are going to be pitching YETI today. So just the goal of the consumer sector is to research and invest in companies that fit our thematic focus and provide profitable returns and high growth. Our two focus themes are alternative foods and reusable goods. And we're trying to focus on companies that are well-known household brands, ESG focused and forward-looking.
Just to kind of go over table of contents, we'll go through our investment thesis, the industry overview, YETI's analysis, how they're dealing with ESG integration, and then finally the valuation.
So to start with our investment thesis, based on our research, it comes down to these three main things that YETI is actively doing that make it such a great investment. It's changing its demographics from consumption-based to focusing on household goods, which is reaching a broader market. YETI is also entering into new geographic regions such as the UK, Europe, and Australia, again, just like growing in market size. YETI is switching from wholesaler to direct to consumer, which is a huge shift that will allow them to improve their margins.
So obviously we are recommending to buy YETI. Our price target is around $66. The current price actually, as of about 5 minutes ago, is around $52. It was up 4% this morning. So the current price of 50 is a little outdated, but close enough. Market cap is 4.14 billion. It is still a really young company. That's partially why we like it. I will also note it first was publicly traded in October of 2018. So obviously has only traded for around 2 years. In terms of ESG factors, there's strong supply chain standard. They have consistent audits and a really good oversight of their manufacturing, despite it being from a third party. They are also looking to shift production of goods primarily out of China and other countries where, for example, chemical usage can be a little, shall we say, skeptical or maybe unethical. And they're looking to kind of move more towards US and other smart, safer manufacturing sites. That was something that they were going to do pre-COVID, but COVID kind of messed with them a little bit. And then obviously YETI's business is based on selling reusable and durable goods. Most of you probably know YETI's products and specifically, their tumblers and their coolers, which obviously eliminate waste rather than getting a styrofoam cooler or plastic water bottle. And then some key catalysts, which Anna already mentioned, the shift from hunters and fishermen to everyday people, direct to consumer marketing, expansion in new markets, and then actually a growing demand for outdoor recreation, specifically during COVID-19. Some risks we did identify, though, is a decline in consumer spending. We'll talk about how this is somewhat mitigated. A shift towards paper and plastic as COVID is seeking to find more sanitary ways of, selling coffee. And for example, you can't go to Starbucks and give them your reusable coffee mug. You have to take their plastic or paper one, which obviously creates more waste. There are a lot of entry-level companies and other sorts of competitors such as Arctic, Hydro Flask, Nalgene, Camelback, amongst others, amongst a lot of other small companies. These are companies that really could disrupt YETI in terms of just taking over market share. However, we tend to think that Yeti's brand name would really help them out in this case. And then lastly, COVID-19.
Next, we're just gonna talk about the industry as a whole. So we put together this 4 to 5 forces analysis that Yeti competes in. And as you can see, all of them are pretty moderate. Nothing really poses a significant threat for supplier power. Usually small companies that are also supplying the same companies to similar household good production brands. This may also change as Yeti develops their supply chain, but overall Yeti just doesn't have that much influence on their suppliers. Threat of substitution, brand loyalty is really important, especially with Yeti, but the product itself is easily replaceable, and there's really nothing too proprietary about the industry. New entrants, it doesn't really take too much capital to enter this market, but brand awareness is what would cause the significant barrier. Buyer power, switching costs are low, and quality is usually very important, which is where the brand loyalty comes from. And as of right now, there's only like a few companies to choose from that been listed before. Competitive rivalry, fairly moderate as well, since new products can be very similar. There's definitely competition for market share and customer loyalty. Brand recognition is very high for Yeti, which works in their favor, but potential increase in competition if prices become more competitive. But overall, the industry definitely has room for profitability.
And so to continue on with the industry outlook, we've mentioned some things that including trend towards household goods such as coffee mugs, wine glasses, dog bowls. But continuing on with kind of themes specific to Yeti, there's a shift to direct-to-consumer marketing rather than going through retailers. This may not seem like a big deal, but in the consumer sector in general, where margins are really low, excluding the wholesale or the retailer would obviously increase margins for Yeti. And increasing margins is much more important than growth to a certain degree, because we're talking about net income ratios of 8 to 10%. So that difference is pretty significant. And then also direct-to-consumer approach allows Yeti to move to international markets easier. You don't have to build relationships with retailers in Europe and Australia, the UK. And then lastly, and we'll go over this in more detail in a couple slides, but there is definitely a trend towards outdoor activities. And as a result, those retailers that do have lower margins are also seeing increased growth in their own sales, which are definitely leading these companies into some good numbers these upcoming quarters.
This is just a graph that was in Yeti's 10K. So as you can see, this just shows how well Yeti stock performance has been since their IPO, and 2019 was a very good year for them as they outperformed the S&P 500 by quite a significant amount.
To kind of go off of what I was speaking on before, COVID has definitely promoted outdoor sports, primarily because it's the only thing a lot of people can do. I know in New Hampshire, where I'm from, fishing licenses and hunting licenses are up big. I picked the state of Texas specifically because that's where Yeti's based, and that's where the inspiration behind the product came from, is fishing in Texas. So fishing licenses are up 70,000 since the start of COVID. And then looking at some other retailers and companies kind of on the periphery, Sports and Warehouse saw 54% growth in their quarterly sales ending in July. Dick's Sporting Goods saw 103% growth in quarterly sales ending in July. They do tend to see historically a growth in Q2, primarily as people look to go camping and stuff. But year over year too, for example, Dick's Sporting Goods saw in Q2 of last year, they had $2.2 billion in sales. For this year, they had 2.7 billion, obviously a pretty dramatic increase. And then lastly, national boat sales spiked by 14%. I know it's kind of a trivial stat, but ultimately the push towards outside is getting people more exposed to Yeti as a brand. And while they may not necessarily go to Dick's Sporting Goods or go to Sportsman Warehouse to buy a Yeti, you know, they see it on the way out. They think, oh, I could use that. I could buy it, and they grab it. And then lastly, one other kind of fun headline, which again seems trivial, but is somewhat relevant, is that the reusable water bottle trend, I guess, is important to millennials and Gen Zs. So that article speaks about how certain people prefer the hydro flask over the Yeti, and how despite, you know, a $50 reusable bottle, people are still going out to buy them. And it speaks more or less to the brand awareness and the prestige that these brands carry, which goes back to our Porter's Five Forces about how Yeti's got the brand recognition to compete with companies like Arctic and Hydro Flask, which are less developed.
Now we're just going to talk a little bit about the company itself. It was founded in 2006, sells reusable water bottles, coolers, other household goods. First went public in 2018, so relatively recently. Like we mentioned before, going to be selling products through direct-to-consumer approach. This is their CEO. This is just like a graph of their stock performance and just some small ESG efforts that they've done recently. Is they now have a VP of ESG, and again, they're just really good with keeping up with their supply chain and their suppliers and auditing them and making sure that they're following all the rules and regulations that they should be.
So to give you a timeline of the company specifically, because it's a young company, 2006, company was founded by brothers Roy and Ryan Siders. They're primarily like just fishermen who originally they wanted to make a fishing rod company and realized they just couldn't do it. So they built a cooler, and basically their whole idea was, let's make a cooler for the avid outdoorsman. So they weren't afraid to price it in the $300 to $400 range, where, you know, companies like Igloo and other sorts of manufacturers were maybe pricing it around $100. They basically were saying, you know, that's fine. We'll just make it more expensive, higher quality, and it'll become somewhat of a luxury item. And so in 2008, they came out with the Tundra, which is seen in the bottom picture there. It's the one with the wheel, the white one there. 2012, the private equity firm Cortec buys the majority ownership of Yeti. They sold out when Yeti went public, made a ton of money on it. 2014, Yeti announces the tumbler. This is probably the item that most people own. I know I have the coffee mug right here. Somebody probably owns some method of this. And this is kind of where they really expanded the brand, which you'll see in 2 slides later, about kind of where they grew. And then 2018, Yeti has its initial public offering.
So going more into the risk and mitigation of these risks. So Yeti sells an expensive product, therefore like drop in consumer discretionary spending could result in declining sales. Yeti has strong brand name. However, there is room for competitors such as RTIC and Hydro Flask to take over some market share. Resource and operating management will be crucial to keep up with the growing customer base and product lines in order to continue to meet customers' needs. But by expanding into the geographic regions, it mitigates the risk of declining consumer spending since the reach is more broad. And in regards to new entrants, Yeti is definitely one of the most popular reusable good producers, and the name is recognized by most people. As mentioned before, the shift to consumer sales increases their profit margins, which will expand their income regardless of any potential lagging growth. And then later on, we're going to go into a little more detail with ESG, but one of Yeti's strong suits, which we mentioned before, is how they monitor their supply chain and regularly audit their suppliers to make sure that they're following everything correctly. And they do produce all reusable goods, which demotes the uses of single-use plastics. And product safety and quality is something that is continuously just being looked at and improved.
So to go kind of into how the company is growing more specifically, first, if you look at their net sales for the last 12 months as of Q2, you can see that coolers is actually the smaller part of their business now, despite that being the majority at the start. So drinkware has definitely grown significantly to 57% of their business. And with that too, you also see a shift in their demographic of consumer. So if you look on the right picture, percentage of female buyers in 2015 was 9%. Now it's 33%. That's likely due to just the expansion of their products. As you can see above too, 2006 is primarily for hunters and fishermen, and now you have beach, snow, campfire, barbecue, dog bowls at home, lunch boxes. So obviously you're broadening your horizons. I'm not a big fisherman or hunter, but I still own a Yeti. I'm sure somebody else has a similar relationship to the company. And then the other interesting key point that I want to point out is its net sales CAGR for the last 6 years has been 47%. This will be critical when we look more into the evaluation. And then lastly, the direct to consumer sales grew by 93 million in 2019, or 48% of their sales. We expect this to continue as the company emerges in Europe and with the COVID-19 crisis increasing demand.
Now going into ESG integration. So all of these scores are from MSCI. For environmental, they're rated 3.7, but the industry average is 3.3. So 58% of revenues are from products with limited packaging, and it is a reusable product. But due to the nature of plastic production, the chemical usage is regulated. And according to MSCI, currently there's limited evidence of efforts to minimize this. But that could partially be because of production right now being in China. And as we said before, like Yeti's trying to move that in the near future. Their social score rated 6.3. This is due to their reliance of supply chains and regions with poor working conditions and promoting fair labor practices within their supply chain. And as I mentioned before, actively performing risk assessments on suppliers. And Yeti has a governance score of 5.8. The industry average is 5.2. Board diversity is something that could be improved, but is currently comprised of 77% male and 22% female. But all of the board members have significant industry and financial expertise.
And then some specific ESG efforts. Obviously, the drinkware itself is stainless steel. It results in a long product life and also reduces overall waste. We've mentioned the supply chain labor standards numerous times so far, but another key point is that Yeti works specifically with the International Packaging and Printing Company in order to produce labels that eliminate 95% of adhesive waste. So if you were to buy a product, there's not like a full box for it. It just kind of goes around the edge of the Yeti, enough to market it, but also what would be considered responsible packaging and also very wasteless. And then kind of some more fun things. Yeti built their current headquarters in Austin, Texas with sustainability in mind. So they used almost all like used products, used denim, used inner tubes, used wood. They also specifically hired local labor and used kind of low-vac paint, which has like healthier chemicals or not as harmful chemicals to the environment, LED lights, and it actually looks like a pretty cool HQ if you're to look it up. As we mentioned, it's kind of a point of growth for the company, and something that we hope they can really grow on is they have hired a VP of ESG initiatives, Holly S. Castro. This is pretty recent. This is more of like a future-oriented ESG effort. We see this as a spot where they can really focus and grow. Specifically now that they have somebody on their executive or their C-suite kind of focusing entirely on those efforts. So this is where we may see Yeti shift its manufacturing, maybe use more responsible chemicals. It definitely shows an initiative to increase board diversity and management diversity, which is important too. And then lastly, their MSCI rating was AA, which was higher for consumers specifically.
Now going into the valuation. So this is the DCF that we put together. These are the growth rates that we predicted, but they're actually under what analysts are projecting. And this is the terminal value we came up with our calculated WACC of 7.79. And with the market value and target price, we're predicting an upside of 27%. So definitely predicting an appreciation in value.
Now to go over some of the key assumptions. So due to the youth of Yeti's business, the growth rates are going to be really volatile. As you look at the historical growth rates in the bottom table there, obviously been a pretty crazy 5 years, from 217% growth to negative 22% 2 years later. It's going to be all over the place, and that's specifically due to its youth and basically potential for growth. So we, as Anna said, we kind of underestimated the growth rates, specifically because we have no idea the volatility, how that's going to impact it. So we said we figured understating it would be the safest bet. The terminal growth of 6.75%, this is definitely, I understand that this is a very high growth rate, specifically because it would outshine GDP growth, but we put that there specifically because the company is so young. If you look at FactSet, most analysts are projecting an 18% growth rate for the next 10 years annually. That's pretty high, obviously. So we said, you know, obviously 6.75 is high for a terminal growth rate, but with the youth of the company, we feel that that could have been could be responsible. Some other key points: our bull prediction would imply a share value of around $82. Normal is around 66, and then bear would be 44. So obviously you can see the upsides there. For the bull scenario, it'd be around 36%. Normal, we're looking at about 21.5, and then the bear case would be negative 17%. And then the other key point I wanted to mention was the average growth rate over the last 5 years, year over year, was 62%. So obviously our projected growth rates are significantly less than that. Now, a company can't grow at 62% forever. We understand that, but we also think that 15% is a reasonable growth rate for the first 3 years, with 10 and 8% falling right behind it. And then just to conclude here, I know we've kind of reiterated ourselves a couple times here, but the main drivers in our investment thesis are expansion to European markets, shifting demographics of YETI, direct-to-consumer marketing with improved margins as a result, and then the strength in the brand name and the willingness to continue to buy reusable water bottles and other sorts of sustainable products. Obviously, in terms of its ESG integration, it's a sustainable product. That's what it's based on. Strong supply chain standards, limited packaging, and then hopefully growth with their VP of ESG. And then to reiterate, the stock predictions, our bull case would see the stock go up to $82. The base case would see it go up to 66, and the bear would see it go to 44. Are there any questions?
I just have a quick question. Can you guys hear me?
Yeah.
Okay. I was literally talking for like 5 minutes in the beginning of this and no one heard me. So sorry about that. But so I saw that on the C-suite, there's like a new position, or a newer position, I would assume, of like talent and ESG. Like there's someone that's ahead of that. So can you, maybe, I don't know if you found your research, like, can you talk a little bit about like what they're focusing on now, or like, is that a new position? Like, is she kind of qualified to be in that position? Like, does she have experience in ESG? I don't know, like, how much you kind of dug into that role.
It is a new position. I'm trying to remember when exactly she was announced. The goal of her role is specifically to obviously continue to focus on ESG for YETI. Part of that focus would be supply chain and chemical usage, just because they are concentrated in China. I did read they're looking to move out, but at the end of 2019, COVID kind of limited them. It's pretty hard to find a new manufacturing facility in the mix of this. So I think right now they're trying to shift their focus in terms of manufacturing specifically.
Awesome. Thank you.
All right. I have a question for you guys. Just so I'm curious, obviously, like YETI and those products, those are, you know, necessity spends, they're discretionary spendings for most people. What's the variability within their revenue look like on a seasonal basis?
Are you saying like quarterly?
Yeah, like when do they tend to sell more products? Is there a time they tend to sell more? Like what's that look like?
Yeah, traditionally you see a lot more in Q4 around Christmas.
Yep.
It's fairly consistent from then on, or like Q1 through Q3 is pretty consistent, primarily because their products. I mean, I can't remember exactly off the top of my head, but I don't remember seeing like a ton of variability. And I would attribute that specifically to the diversity of their products. Obviously, you can use a tumbler for water or coffee, so I don't necessarily think it necessarily dependent upon the season. But I would definitely say you see a lot more in Q4 from what I remember, specifically because of Christmas and holiday spending, that sort of thing.
All right, cool. And do you have any idea like what their revenue breakdown is per like item set, or how they break that down?
Yeah, and if you want to, there was a slide on that. It was 58% drinkware and around 42. I can't remember the exact number. Slide.
Yeah, I thought I saw that in there.
57% drinkware and then 41% coolers and equipment, and then the other being like merch and stuff.
All right, nice.
Well, if no one has any other questions, thank you guys, and I guess we could turn it over. Oh,
I just had one. I just want to know, do you guys know at least like what the main like what the main countries that they might be moving their operations to might be? Like, do you think it might be like Vietnam, Korea, Japan, or would they all be coming to North America? Do you know? And also, do you know what the main impact that would be in terms of costs?
You kind of cut out there, but if I'm understanding your question correctly, you're asking which countries specifically they're looking to expand to?
Yes. Can you hear me right now? I'm sorry if I cut off.
Yeah, you're good now.
Yeah, that's essentially what I was asking. Like, do you have kind of like an idea of where specifically they might move their operations and kind of like what the cost impact would be of that? If not, then no worries.
Yeah, they haven't actually said where they're going to move their manufacturing. In terms of where they're moving, like their focus in terms of sales, it's definitely towards Europe and Australia. I know as of right now, 97% of their sales are in the US. So they're trying to shift that more towards a balance across the US or across the world.
anything else? No. Okay. So yeah, like I was saying, if no one has any more questions, we're gonna turn it over to Haley and James to go through their Prologis pitch. But great job, Anna and Ben. Thank you guys.
Is there any way we can give James the sharing? Oh, are you able to do it? Okay, cool. I have to leave right at 3, so I'm sorry if I can't stay for questions.
Yeah, no worries.
Okay, so hi guys. Today me and James are going to be presenting a stock pitch for Prologis. Just an overall goal for the financials and real estate sector. We want to focus our research on financial service companies and REITs that are continuing to make an effort in the ESG space through the implementation of ESG investing strategies, community outreach programs that enhance financial literacy in underdeveloped communities, for example, board diversity, and then deployment of various sustainable infrastructure strategies like energy efficiency, low carbon emissions, or solar panel deployment, which is what we'll be focusing on today mainly with Prologis. And then just introductions, I'm Haley Crangelo, junior at Bentley right now, and I'm majoring in corporate finance and accounting.
And my name is James Agnelli, also a junior majoring in corporate finance and accounting.
So in terms of company overview, Prologis is an industrial and logistics REIT, namely one of the largest in the world. So they focus on building large facilities or warehouses for global companies like Amazon, FedEx, Home Depot. L'Oreal, among other well-known corporations. They were founded in 1991 and currently have headquarters located in San Francisco, California. And overall, their goal is to design, own, manage, and invest in logistics real estate in a manner that's both building and creating value for their investors on a global scale. And their operations focus on two main segments. So their real estate operations represents their ownership and development of logistics properties, and then strategic capital segments, which represents management of co-investment ventures and other unconsolidated entities. Additionally, Prologis currently has about $72 billion in total assets under management, around 680 million square feet in 3,000 or so facilities that are spread throughout 19 countries and 4 continents throughout the world, and also serves more than 5,200 customers. In terms of financial performance, as of yesterday, their price per share is around $100. Obviously, they saw a drop in their share price late March of 2020, as did many other companies due to COVID. However, they were quickly able to bounce back and have steadily remained above the S&P 500. And overall, their stock price has continued to grow since 2014, seeing an average of a 12.4% increase in share price per year. Their CEO is Hamid Moghadam. Hopefully I pronounced that correctly. He's a graduate of MIT and Stanford graduate, and became co-founder of A&B Properties, which is also a REIT in late 1980s, and then initiated the merger of A&B Properties and Prologis to create the current Prologis right now. And so he became the CEO of Prologis in 2013. And then in terms of ESG efforts, we'll speak in more depth about their ESG initiatives throughout the presentation. But briefly, Prologis is known to be one of the top leaders in solar power deployment among the industrial REITs, with the installation of solar panels, LED lighting in their warehouse facilities. And they're also aiming to build warehouses that abide by green building certifications for leadership in energy and environmental design. They're the first REIT to issue green bonds, and we're also going to touch base on their community workforce initiative and diversity and inclusion strategies. So our investment thesis: as a top leader in solar power deployment among the industrial REITs industry, we believe Prologis has significant potential for the future. They're continuing to enhance their sustainable efforts through solar power generation, LED lighting, obtaining these green building certifications for their warehouses, and their management has really capitalized on these opportunities to build for the future by developing top-rate customer-focused renewable energy solutions. And as we'll see, they've remained pretty ahead of their competitors in sustainable practices as well. So I already mentioned their price per share is around $100. Price target, we have set it about $110, which James will explain more in depth in the valuation. Market cap about $78,000 million. And then again, in terms of ESG, MSCI rating is AA, so definitely pretty high. Bloomberg rates them at a 42.6, and this is scaled out of 100, and it's based off of research that Bloomberg conducts from their corporate social responsibility to sustainability reports and other public sources about the company. And then, as explained before, their sustainable infrastructure focuses on solar panel and LED installations, the building certifications, green bond. Their females on board is about 27.3%. Then we'll also talk about their community workforce initiative for labor solutions. In terms of catalysts, obviously Prologis has established themselves as the largest logistics real estate investment trust in the world. They've also been ranked extremely high in comparison to other REITs for their sustainable practices. Additionally, I'll dive more deeply into this on the next slide, but one main catalyst for growth within the industrials and logistics real estate sector is e-commerce, because as e-commerce continues to expand, the need for warehouse space is going to increase, which will positively impact Prologis and other industrial REITs. And then Prologis has also proved pretty resilient during the start of COVID, which has allowed them to give back to the community and adjust for future ESG and financial metrics. And then in terms of acquisitions, they recently had an acquisition with Liberty Property Trust and Industrial Property Trust, which obviously will create more growth opportunities. And then for risks, we'll touch base on this in more detail, but macroeconomic events that can impact foreign exchange rates, interest rates, and their tenants' ability to pay back their rent and other obligations are obviously risks for industrial REITs, and then also climate-related risks. So for industrial analysis for industrials and logistics real estate companies, most of this information I found from the American Commercial REIT, CBRE. In April 2020, they had a flash call for COVID-19 impact on industrials and logistics sector, and basically discussed two main areas of growth, which is through e-commerce and also the increased inventory held on hand for e-commerce companies. So industrial REITs overall have remained steady amid COVID-19 impact relative to other sectors, and so they're best positioned for the post-COVID world. In terms of e-commerce, this is a huge driving factor for industrial REITs, and especially with the increased online shopping that we're seeing. CBRE suggests that for each incremental increase of $1 billion in e-commerce sales growth, that there's going to be need for 1.25 million square feet of warehouse space. And they're projected that e-commerce is going to increase by 15% annually. Overall positive need for increased warehouse space. So this definitely gives Prologis and other industrial REITs increased opportunity to capitalize in new development projects. Additionally, increased inventory will drive demand for warehouse space. CBRE touched on how modern supply chains are trying to follow the just-in-time inventory strategy. So where these companies are trying to hold the minimum amount of inventory on hand. However, there's been weakness shown in this strategy, especially when the source of production shuts down. So they project that going forward, amount of inventory held in reserve and on hand is going to increase, and therefore increase the need for warehouse space. Also, obviously right now it's a low interest rate environment, so this allows industrial REITs to more easily obtain funding for their development projects. Additionally, nearshoring and onshoring of manufacturing will also drive domestic production. There's been a change in location of manufacturing sites where we're seeing manufacturers diversify their production locations by looking to build facilities in North America rather than Asia. And then additionally, since more consumers want to receive their deliveries as soon as possible, industrial REITs have been changing their business strategy from building warehouses on cheap land to building in areas that are closer to major population centers. So overall, those strategies and changes are going to enforce more warehouses to be built, with will positively impact the industrial REITs industry. And then I also just wanted to mention the CARES Act because it provides a backstop for tenants that aren't able to pay for their rent. It stands for the Coronavirus Aid, Relief, and Economic Securities Act. So it provides certain protection from eviction and late fees due to non-payment of rent for tenants. And then just quickly, ESG industry trends. So environmental stewardship, social responsibility, good governance. So with environmental stewardship, just focusing efforts on energy efficiency, sustainable building materials, issuance of green bonds, social responsibility, developing partnerships with nonprofit organizations, good governance, just the implementation of having cross-functional ESG teams, ESG executive compensation policies, diversity and inclusion initiatives. So all of that is important for these industrial going forward. And then so for risks and mitigation, some of the main risks, climate-related risk, so severe weather, flooding, coastal risk that may impact their warehouse facilities globally. Also fluctuations in foreign exchange rates. Prologis has about 30% of its properties outside of the US, so foreign exchange fluctuations could create a significant risk for them. Interest rate fluctuation, the company also has significant interest risk exposure to its balance sheet. So any rapid interest rate change in the US, Japan, or Europe may also have a major risk for their company. And then with tenants, obviously there's a large risk if the number of tenants that fail to pay back their obligations or rent due to different macroeconomic events occurring. So to mitigate these risks, especially for climate-related risk, Prologis has a board that oversees all their climate-related risks. Their chief legal officer oversees risk management and ESG team strategies. And then in terms of the fluctuation in foreign exchange rates, based on Prologis' Q2 2020 earning results, these were released in late July. They note that they basically assume a constant foreign currency rate when they record earnings, but they make the necessary adjustments at the end of the fiscal year. And interest rates, so they're low right now, so that reduces overall risk for external financing. And then, as mentioned previously, the CARES Act obviously gives tenants various options for how they choose to pay their rent back. And then briefly with ESG influence, there's just been increased customer preference for clean energy solutions, and customers are also being more environmentally cautious on where their facilities are located.
All right, so I'll take over now from Haley and talk a little bit more about the ESG factors. So starting off, just looking at some of the material factors we're looking at Prologis, as mentioned earlier. So you have our solar power, the community workforce initiatives, LED lighting, and sustainable building certifications, and then the GHG emissions reduction. Some third-party data I wanted to mention was GRESB actually ranked them as the #1 industrial REIT. And also they're the first REIT to set a science-based target, which essentially shows they're working with outside sources to set targets, working with scientists to figure out what they can actually do to really make material change. And also they're AA on MSCI. And then here you can see the SDGs, 7, 8, 9, 13. But actually, Prologis was nice enough to actually get out a report that maps these SDGs to their goals and progress they've made so far. So a couple I really want to highlight here are their solar power generation for SDG 7. They've actually hit their goal. In 2019, they set the goal of 200 megawatts, but they actually beat that to 212, and they want to hit 400 by 2025. So they're on track to hit that, and it's really impressive that they were able to do that well that quickly. But you can see all the different ones. So LED lighting is also part of their buildings. So cool roofs is another one too. Pretty much just all things you would think of when you look at a big warehouse. How could it be more sustainable? They're doing all of that. They have goals and they've mapped it to the SDGs. Then looking deeper into that, so their solar capacity, LED lighting, that's the megawatts, the 200 megawatts I mentioned before. The LEED certification, so this is from the U.S. Green Building Council. They try to get LEED certification on all of them. I'm sure we're all familiar with that, as our Bowen Bentley Arena, I believe, is LEED Platinum or Gold or something like that. So same system as that. And then they were one of the first to issue green bonds. They're actually the largest REIT right now with green bonds. And that's really important because green bonds can only be used to fund green projects. So it shows that there's really a commitment there to doing green projects. And then socially, there are labor solutions, so community workforce initiatives. That's like just having their employees go out in the communities they exist in and just doing work to help the communities. And then there are 3 C's. Part of that is the customer-centric building design. So part of that is building their warehouses with the health of the employees of their tenants in mind. So it said things like having like standing desks or like areas where they can have health, workouts, things like that, having those in these buildings for the employees to stay healthy. And then just a little taking care about their governance. 5 new directors in the past 5 years. They have 3 female directors in the age range from 40 to 72, which is pretty diverse age-wise. And then they have the female board also. And then hopping to COVID, something like Prologis, you may have looked at like 6 months ago and said that looks really bad because, everything's shutting down. Logistics REITs doesn't sound like something you dive into, but they're actually able to recover impressively. And 2 big numbers you want to look at here are July's rent collection and August rent collection. They were actually able to collect 98.7 and 96.9% of their rent collection, which is really impressive, especially during the pandemic. July and August was pretty tough, but they were still able to get that much. So they recovered really quickly from coronavirus, even though it seemed like a crazy obstacle. And then here we'll dive into the valuation. So starting off from Bloomberg, pulling the analyst ratings, we have 14 buys, 4 holds, and 1 sell with the price target of 112 and like roughly 12% upside. That's pretty solid. We'll move over to ESG competitor analysis. So looking at this, they're the clear leader of this group. So if you look at MSCI, they're a AA. The second best is an A, and then the other 2 are BBB. In terms of Sustainalytics score, they're 86.5. The second highest is 73.4. So the best by far in that also. And then Bloomberg ESG score, they're not the best, but they're the second best, and the rest are falling below them. and then also their Bloomberg ISS. Pretty much they're just a clear leader in this industry, and they beat out their competitors on most scales. And then if we jump into the financials comparables analysis, if we look at their performance over the year, they're actually the best by a decent margin. They're also a much bigger company than any of these competitors, so that's something to keep in mind, that these aren't direct competitors just because the size of Prologis is a little bit larger and they focus on a little bit different type of real estate. There's really no direct competitor, but definitely a lot larger company. Look at their dividend yield, they're actually a little bit less than their competitors. And then this P to AFFO, that's essentially like your PE ratio you would typically see. Because it's a REIT, you can't really use a PE ratio, it doesn't give you the same information, but P to AFFO is basically a PE ratio. And this makes them look a little bit expensive, but we think that the other factors outweigh that. Their EBITDA is about the same as other companies, and then their AFFO CI1, that's essentially their earnings per share, and that's 330, which is only less than Boston Properties, which is really high. I'm not sure why Boston Properties is so high, but yeah. And then here are our price targets. So for our base case, we did a 9% growth in the revenue, and that's on par with their past 5 years. Their average is about 9. When the past couple of years, it's been higher. I believe in 2019, it was like 18%. We figured that was fairly conservative and realistic. Oops. I totally clicked the wrong thing. One second, sorry. Okay, yeah, so we can see that base case is going to be a 9.73% return at the price target of 125. We did our bear case, I did a 7% growth, so 2% less. That's going to pretty much break even. It's negative 0.1%, but basically breaking even. And our bull case is only at 10%, so I didn't get too, want to stay conservative with it, didn't get too crazy with it. 10% gives about a 15% return. If we had done 11%, that got up to a little over 20% return. So it makes a big difference depending on what number you put there. Here's the DCF. So yeah, projected out till 2024. I don't believe the terminal's on here, but bringing it down, once you take out the diluted shares, we ended up with 1025 or 110.25, which then gave us that 9.73% return. Yeah. And then pretty much our conclusion, we recommend a buy at the current price because it's a leader in ESG REITs, their ability to have mutually beneficial relationships with e-commerce giants, and then their proven resolve throughout coronavirus. Thank you. Are there any questions?
I just have one. I don't know if you touched on this.
Mhm.
Part of the presentation actually cut off because of my audio. I don't know if it's because of my Wi-Fi. But did you ever speak to at least the dividends? I know that at least in REITs, or at least some of them, the main, basically like the most attractive thing about REITs is basically the yield on their dividend, essentially how stable it is. And obviously, I just want to know what is Prologis' dividend and how has it performed?
Definitely. So I think it's been pretty stable. Oh, sorry. Yeah, so it's definitely been pretty stable. It's not the highest. So if you can see here, it's the 2.25%. So it's not the highest. It's decent. It's fairly stable, but it's definitely not the highest. It's nothing extreme. Wouldn't buy it purely based off of the dividend.
I just had another question, and this just mainly because I don't know much about obviously real estate investing as much.
Mhm.
So could you define at least like what AFFO is?
Yeah, it's
Just get a better
adjusted
sense.
funds from operations. Yeah, so it's pretty much just like the equivalent of what you would see as like earnings or like a EBIT for a regular company. It just doesn't work the same for a real estate company.
And then just last question. I'm sorry for being so
You're
picky.
good.
But the last one, I think you said this in the advisory meeting. But when you say it's the biggest green bond issuer, do you mean by in terms of volume, in terms of how many green bonds
Yeah,
they issue?
so within REITs,
Mhm.
yeah, so within REITs, they have the most quantity, like so money-wise, like value-wise, they have the largest green bond issuance.
Okay, and I forgot. I don't know if you mentioned this, but do they have
Mhm.
kind of like green bonds for each one of the projects that they kind of engage in, or is it just a set like one issuance that has as
I'm not
much?
sure how they have it split up specifically to their projects. I don't know if they release that, but I know that if they do have a green bond, that has to fund a green project. I don't know if every project they have is funded by green bonds. There's probably some that aren't, but yeah, they have the green bond that has to fund the green project.
Yeah, to add to that, they disclose all of it in their financial statements. So like their investors can see where their money is going to and which projects are used with the green bonds issuance. So that's how they tell their investors.
Excellent. Thank you. Really good pitch.
Thank you.
I have one question about the comparables. If you want to go back to that
Definitely.
slide just for a minute.
This one?
Yeah. So obviously their dividend yield is significantly lower than everyone else, and they're the most expensive. And compared to that, what is it, after AFFO, whatever that is?
Yeah, but just for yeah.
How do you look at that? Because usually like a higher dividend yield may support the fact that a company is more expensive. So with it being the lowest dividend yield and the most expensive in terms of that metric, like how would you, I guess, justify that?
Definitely. So the way I look at it is these aren't exact competitors, so that's why I don't value that as that much. So while this definitely does look expensive, and they're definitely towards the higher end of their like 52-week range, while that does make it look expensive, I think the other factors value more into that. The dividend yield definitely is the lower of the group, but I guess my response to that would be that these aren't great competitors to put. Like there's no exact competitor to this. If you look at the size of these companies, and they don't all do logistics only, so that's why I think it's a little bit not perfect comparison between these two. So it is high. I recognize it is high, so it is definitely a little bit expensive, but I think that it's still a good buy, even though it is expensive right now.
Thank you.
Any other questions?
I don't have any, but great pitch, guys.
Thank you. We can't hear you, Elise.
Can't hear you, Elise.
Sure, should say great job, both pitches, and go vote if you have not voted. The link to the form is in the chat. Yep. Okay. And see you at Sustainable Trivia tomorrow night at 9 p.m.
Thank you.